have you. I hope you guys are all having a fabulous Wednesday. My name is Lachey, and I am here with Alex. Wave, Miss Alex. We are your event coordinators for this event. We just want to thank you all for attending tonight's Zoom discussion as part of our Community Expo virtual session. Tonight's topic that we're going to be going over is financial tips and how their resources can be helpful and beneficial to your family. I'd like to welcome all of our partners that are volunteering their time tonight on tonight's panel. Please welcome, we have Steve from Navy Federal Credit Union. Wave, Steve. We got Rena from STEP, David from USAA, Gretchen from Navy Marine Corps Relief Society. We have Kyle and Mike from New York Life Insurance, Mark from Mark Sigmund Insurance Agency, Felipe from San Diego Financial Literacy Center, and Dino from North Island Credit Union. So let's go ahead and get started. The first topic that we're going to go over will be financial coaching. The question is, what type of financial coaching are you offering right now for military families?
Since nobody heard me, you should all imagine that what I said was brilliant, inspiring. You're tearing up based on my comments, right? This is what I always say when I'm muted, because I'm muted all the time. I'm not tech savvy, but I am money savvy. So I'm here from NMCRS. We're really happy to be here. And a little bit about us, 2-minute intro and the services we offer. We were founded over 100 years ago. Actually, the proceeds for our first donations came from the Army-Navy football game. So that's where our money came from. We are a nonprofit institution. We provide budget counseling. We provide interest-free loans to those who need. One subset of that is a quick assist loan. If you guys need money, you need it quickly, you've got some kind of emergency, we give loans of $500 or less. We get you in and out of the door in 15 minutes or less, and we have offices on base, okay? We have lots of other services, so I'm gonna try to highlight the big ones. We have Budget for Baby. If you know someone who is expecting or who has a newborn, they can come join our Budget for Baby class. We have lots of great tips and giveaways for how to do financial planning for your growing family. We have in San Diego, actually at the Miramar base, we have one of the largest thrift stores on a base in the world. We have limited hours, so check in because of COVID as to when we're open, but lots of great stuff and heavily discounted, gently used uniforms. We have a visiting nurse service for those who are in need. And for those who are looking for a place to donate your time and talent, you can always volunteer with us. We reimburse for childcare and mileage. All right, how am I doing on time? Was that good? Did I talk quick enough?
No, you did great. Thank you, Gretchen. And we'll go ahead and pass it on to Miss Rena from STEP.
Hi, everybody. So thank you so much for joining us in your evening. So Support the Enlisted Project, we're currently providing personalized, goal-oriented, and individualized support in helping you identify, set, and achieve your personal financial goals, whatever that may be. Our caseworkers, we work with you to learn what it is that you want to accomplish. We use your past successes to help get you there so you can build a path to that brighter financial future. We also still provide our emergency grant assistance to stop the loss of critical basic needs to eligible military service members and veterans who have a documented need. And of course, you know, we're pretty much here for anything that you might need us for. We're ready to help and we're ready to get you going on your path to a brighter financial future.
Awesome. Thank you, Ms. Rena. Next question is about insurance. What type of insurance should military families consider getting? I'm going to pass the mic to Mr. Kyle.
So I'm muted. I just want to thank the military families. Thank you for keeping our country safe, and we definitely appreciate that. I want to say that New York Life, we've been in business for over 176 years. We're one of the largest life insurance companies in the country, and we are also a AAA rated company. When it comes down to life insurance, it's I want you guys to think about life insurance as income replacement. And what I'm going to do is explain life insurance is various types, but it gets down to what's best for your family. And you know, when it comes down to life insurance, there's basically basically there's three types, and I'm just going to go over them just quickly. Term, and I want you to think of them as just like if you're renting. If you're renting a house, your premiums are locked in for a period of time. One thing about term, like your SGLI, for a particular time, it will expire. But right now, where you're in the military, the great thing is at least you have that $400,000 coverage, but that term is locked in for a period. So going back to that term policy, you have a premium that you'll pay every month. It's not going to go up. And then you have a death benefit in case that something happens to you, your loved ones are able to continue their lifestyle. I also want you to think about whole life. It's like if you had a mortgage on your house, let's say you owned your own home, it builds cash value. That's kind of like the equity in your home. And then also the premiums are locked in to age until you're 100 years old. And then you have cash value that, like I said before, with a dividend that can help your death benefit grow. And then we have universal, which is a hybrid of the two. Universal, you have flexible premiums. You also have a death benefit and you have cash value. So that being said, we know that there's SGLI and VGLI. Mark, go ahead.
Thank you, Kyle. And thank you all for taking the time here. I also want to thank you for your service as a retired veteran. I remember what it was like when I was transitioning out. And a lot of the times our military and veterans are told in the last 6 to 9 months, they're told to put everything in their medical record for the VA. If they're separating, the SGLI expires at their EAOS. And if they're retiring, they have 120 days after that to determine their options. Now, regardless of whatever company you choose, the underwriters are all going to base their decision based on your medical record. And as we mentioned before, your VGLI can automatically convert, and it just goes up every 5 years based on your age. So at first, it's pretty inexpensive, but there, when you get toward retirement age, it becomes quite costly. So 2 things for you to protect as you're looking at all of this is your ability to earn an income and your insurability. So we've seen in our careers here is that sometimes veterans face really difficulty getting through underwriting. It's not only the medical conditions, the medications, but sometimes the side effects of those medications that are scrutinized by the underwriters. So digging through the VA website, there's a program that's available for people who are have a hard time getting insurance. And we actually included that in your swag bag drop off. After I get done talking, I'm going to drop it off in the chat window as well. But when I work with my clients, one of the things that they're really surprised to find out is that you can have more than one life insurance policy. So it's not just a one size fits all or one option is better than another. What I really strongly suggest is that you speak with a licensed professional and determine what's best for you and your family. I want to thank you for the time this evening, and I need to pass it on to Mr. David with USAA.
Hey everyone, thanks for being here tonight. Thank you for your service, both the active duty and the military spouse. The military spouse actually has a harder job than the active duty service member. So I work for a small company called USAA, and we started going to be 100 years. We'll be 100 years old in 2022. We started as an auto insurance company, and we've branched off to have a whole host of insurance products. So Mark and his team did a great job talking about life coverage. I just want to touch upon 2 very important other insurances that I know everybody has, and that's auto insurance and renter's insurance. Well, I have no doubt that everybody has auto insurance. It's kind of a requirement just to get a pass to go on base. I know one of my sailors one time, after he got his car, he couldn't pay for the car, the gas, and the insurance, so he dropped the auto insurance. Listen, don't ever drop the auto insurance, because then when you get in an accident, that you're gonna have to pay for that out of pocket, like that young sailor learned the hard way. So, auto insurance, I will tell you that regardless who you go to, listen to your agent, listen to the people when they're making recommendations. Don't always go for the bottom line cheapest minimums. That will cost you in the end. Just a real quick snapshot, every state has minimum liabilities. And for example, the minimum liability for your property on car insurance is $5,000. So if you hit a Tesla and you're just running around with the minimum liabilities, $5,000 of minimum liabilities probably isn't enough to cover the damage to the Tesla. So when they make a recommendation to you, it's not necessarily to get more money for them. It's really to protect you. So have them explain it. The other product I want to mention is renter's insurance, stuff insurance. Guys, listen, I know Lincoln, they used to give you some level, some bits of insurance. They don't anymore. You need to have some sort of renter's insurance. And what some people don't realize is when things stolen out of your car, that's not car insurance. That's renter's insurance. When things are PCSing, sometimes renter's insurance covers that. Some renter's insurance will cover all your uniform items and gear, no replacement, full deductible with that company. So renter's insurance is a small monthly fee for a huge gain. My kid has renter's insurance that also has a rider we call valuable property protection. In his case, he was able to have his musical instruments, 2 saxophones. He's a musician. You know, kids. So he decided to leave his saxophones in the music room at the college, but he didn't take time to lock it up. And they both got stolen. $9,000 worth of instruments. But because of that extra coverage, full replacement, no deductible. Okay, so really look in your renter's insurance. And then one other thing I want to just mention in the last 30 seconds is something called umbrella insurance. When you go through life events, that's when you look at your different insurances. And umbrella insurance is one of those things for a life event, like when your kids start driving, when you make big purchases like homes, when you have a lot of money invested in TSP. Umbrella insurance kicks in after your liability insurance ends. I met an 06 who did not have umbrella insurance, had the minimum requirement on the auto insurance for his daughter, who got into an accident and hospitalized a couple members, couple people. The colonel got sued for $1 million. If he had umbrella insurance with his company, it would have kicked in and covered. So insurance is something that we all need to have that we never want to use. So look at umbrella insurance as well.
All right. Thank you, Mr. David. Question number 3, or topic question number 3, has to do with loans. What should military families know about loans?
Hi, good evening, everyone. I'm Dino Santos. I manage the branch on board NAS North Island. We have 11 branches here throughout San Diego. I myself is a military retiree from the Navy. So I share the similarities with a lot of you. Now, talking about military families and loans, military families should know that they have rights and options regarding loans. Let's say, for example, for their rights, there's a federal law out there that protects military families from predatory lending. It's called the Military Lending Act, or otherwise known as MLA. MLA is a law that provides special protection for active duty service members on many loan products. MLA applies to active duty service members and their covered family members. It also applies to those on active guard or active reserve duty and their family members as well. The types of loans covered by MLA include payday loans, tax refund anticipation loans, certain student loans, and vehicle title loans. Some specific provisions of the Military Lending Act include maximum annual percentage rate. Military members should know that there is a maximum limit a lender can charge under the MLA. And that maximum is 36%. I know it's pretty high, but that's the limit. Another provision of the MLA is that there's no mandatory allotments. You are not required, or military members are not required to create the military allotment to get the loan. If you qualify for the loan, you qualify for the loan, period. A creditor cannot require you to create that allotment. However, some of them may offer a discount if you do decide to do that. That is your option, or that's the military member's option. And then the MLA also protects military families from prepayment penalty. So if you decide to pay your loan ahead of time, they cannot charge you a fee for that, or if you pay a part of it ahead of time. So, we all heard the saying, read the fine print. So let's do that, read the fine print and check for all these things. Also make sure that you're getting the simple interest calculation, not the compound interest calculation. We don't have all the time in the world to discuss the difference between the two, but just to be on the safe side, so you'll save money, make sure that you get the simple interest calculation. Now, with regards to options, military families should also know that they can shop around. Shop around for the best rate, be a smart consumer, even after you secure the loan. One reason is that a lot of the lenders adjust their interest rates to be competitive. So, keep that in mind. Another reason is that your credit worthiness may have improved over time, which affords you the better rate. Often I meet military families who think that they have the lowest rate for their loan. That may be true at the time that they signed the loan or they secured the loan, but things could change, hopefully for the better. And if it does change, the credit worthiness improves and credit score improves. And if that happens, then we're able to get a better interest rate from perhaps other lenders. So keep that in mind. You have options. And I'll pass that on to the next speaker.
All right. So I'm a corporate lawyer at a bank, which means I have to talk about the history of banks, but I promise it'll only be a 7-second history. The whole purpose of banks is twofold. People make it out to be this complex thing, these complex instruments. One is to take your money and hold it and keep it safe. And the other is to lend it out and help the economy get kicking and moving. Okay, that's it. They take money, they lend money. So I want to focus for a second on interest, okay? If you deposit your money into a bank, I'm going to pick on somebody. Tracy Kurtz, hi. Tracy, you won it big at the lotto. You made $1 million. You're depositing it in the bank, okay? You are going to earn interest every month on that money, right? Why? Why? Because banks are so generous? No. It's because they're going to take your money and they're going to use that money to make a loan to, who can I pick on? Amanda. Hi, Amanda. Okay, Amanda, you're starting a fashion shop, okay? And you need a loan for this shop, okay? The bank is going to charge you interest. They're going to say in exchange for this loan, where we could have invested otherwise in securities or crypto, anything else, right? You have to pay us some money each month, right? So let's say you're paying $100 each month in interest. Tracy, since you were so kind enough to lend us your money to give to Amanda for her fashion shop, we're going to give you $50. Actually, interest rates are terrible right now. You won't make that much, but let's make it positive. Okay? You're going to make $50. Okay, so that's great. Interest in your situation is wonderful. It's a blessing. You're making money each month for free, just for depositing your money in the bank. Amanda, I'm so sorry to tell you, interest kind of sucks for you. Okay, it's additional money you're paying each month. And the reason I emphasize this is because I think sometimes people think of loans as a natural, normal way of life. This is something that has happened in our country over the past 60 years because of the way salaries have increased or not increased with inflation. So people are taking out more and more loans. Let's all remember that when you're taking out a loan, you got to pay interest on it. Whereas if you save in advance so that you don't have to take out a loan, you are going to make money on that. Okay, so just keep that in mind. That's the first thing about loans that I want to emphasize. It's always better to save in advance for something than to have to take out money on the flip side because you don't have the savings for it. Okay, that being said, if you have to take out a loan, there's good debt, there's bad debt. Good debt is when you are investing for the future. Okay, you're borrowing money to buy a home to live in. You are borrowing money to get an education. Bad debt is debt that you are taking out to pay for something you've already gotten. Okay, credit card debt. Very, very high interest rate, and you've already bought the item, okay? Let's see, okay, when you're looking at the terms of a loan, Dino did a really good job talking about the fine print. It's all in the fine print. Here are the main things to look for. 1, how much are you borrowing? Did they put the right amount of money down? 2, what is your interest rate? Is it affordable? Is it appropriate? When I got my home mortgage, the day of the closing, my husband's going nuts because I was reading over the thing like line by line, but they gave us the wrong interest rate. And I know you're all shocked to hear it was higher than what it was supposed to be. Okay, so you want to check for the interest rate. 3, you want to check for the term. When do I have to repay this? What are my monthly repayment obligations? And 4th, what collateral am I required to pledge to support this loan? Okay, one thing to note, Secured debt is always cheaper than unsecured debt. So a mortgage where you're telling the bank, if I can't pay, you can take my home, you're going to get a lower interest rate than credit card debt, which is not secured by anything. The credit card company has no recourse against your assets, right? So a lot of times people will say, oh, why don't you just bundle it all? Why don't you just refi your home, pay off all your debt? Please, for the love of God, do not do this, okay? You are putting your home at risk, okay? Don't just automatically consolidate your debts into secured debt under the idea that you're getting a win because the interest rate is lower. The reason you're getting a win is because you're putting your home at risk or you're putting collateral at risk. Think very carefully before you do that. Okay, last item, NMCUS, we have interest-free loans because we are a nonprofit. So if you need a loan, come see us. If it's for a qualified purpose, we will give you an interest-free loan.
Awesome. Thank you, Gretchen. We'll go ahead and move on to credit score. There's a lot of people that are confused about credit scores. Could you explain in general what it is and what affects your credit score? I'm going to pass it on to Felipe.
All right, thank you. And thank you everybody for joining us. Credit score, it's one of the very popular terms when it comes to personal finances. It gets a lot of attention, rightfully so. It's like when you were in school and you had your GPA, and that was like a cumulative of your entire work of schooling and grades. Credit score is like that. A credit score basically takes all the information regarding your credit history, past and present, runs it through a formula, and then gives you an easily digestible number that you can keep track of. And there's a lot of confusion when it comes to credit score because there's so many of them. The most popular credit scoring model is going to be your FICO score. The biggest competitor to that would be a Vantage score. And it's important to realize when you're looking at a credit score, whether it's one you get for free from your bank or credit union, credit card company, Credit Karma, and those kinds of sites, which credit score are you getting? And for all the credit scores, the higher the better. But if you're comparing your, Vantage score that you got for free at Credit Karma to, a FICO score that a lender might be using to determine whether or not to give you a new loan, a car loan, a credit card, or a mortgage, there could be a significant variance between the two. So it's important to understand that there are multiple types of credit scores. For the most part, though, if you're trying to increase your credit score, the two biggest factors that you want to take care of, regardless of which score you're looking at, is payment history. Don't miss payments. If you go 30 days past due, that's going to be the biggest thing you can do to negatively affect your credit score. And then the next one is your debt to credit ratio, the amount of money that you owe compared to the amount of money you have available to spend on those revolving accounts. Keeping that ratio down, making sure that you always make your payments on time, regardless of which credit score you're looking at, are going to be the two of the biggest factors to go along with that credit score that can affect so many different things.
Yeah, well, I only have a couple of things to add to that. One would be like the length of credit. As one would imagine, the younger folks, because they're establishing their credit, they often get the higher interest rate because they haven't had established their credit. After making several payments into a certain loan, their family members should look into maybe refinancing because after a certain amount of time, their credit score or history potentially has improved. So that's one thing I would like to add. And then the other thing is the credit inquiries. Credit inquiries, depending on how many you get and how often, it could impact or have a negative impact on your credit score. Then therefore you won't be able to get the interest rate that you like. So keep that in mind. Keep the credit inquiries to a minimum. And if you need help with building or rebuilding credit, there are some ways to do that. One of them is doing what's called a secured credit, where you put in a certain amount of money and you borrow from that money, and use it as a collateral. Gretchen kind of talked about, a secured loan having a lower interest rate, and that's one way of doing that to improve your credit score. Thank you.
Awesome. Thank you, Dino. The next topic that we will be going over will be about paying off debt. We're now coming off of this pandemic and many families have incurred debt. What are some ways that to pay off debt? I will pass it on to Felipe.
All right, I'm back. When it comes to paying off debt, it really depends on the type of debt and the financial situation overall. If it's something where you can handle your own, what the interest rates would look like. One overlooked way of paying off debt that isn't really well known is if it's like credit card debt and it's at a really high interest rates, to look at things like a debt management plan where you can get the accounts put on a fixed payment amount, usually for a lower interest rate, and get those accounts paid off in 3 to 5 years as opposed to 20 if you were making the minimum payments on your own with the higher interest rates. But that's not going to be right for everyone. It's really a matter of taking a look, sitting down, doing a full-on budget, and finding out, also taking a list of how much debt you have. If you have debt in multiple places, sometimes adding it all up and getting that full total amount can be a little scary, but it's a good way of knowing where the starting point is and how much debt you really have. Because if you spread it out amongst a whole bunch of different cards all over the place, it's sometimes I say we because from personal experience, you lose track of how much debt you really have. And then you're sitting there once you add it all up and you say, what have I done? But it gives you a good starting point. Then coming up with a budget, trying to maximize the amount of money that you could throw at that debt, and then exploring all the different options that are available. Again, one to kind of consider that often gets forgotten, gets lumped in with all the other consolidation, is that consumer credit counseling or debt management program with lower interest rates.
Hi, everyone. My name's Steve. I'm working out of Navy Fed and off of Naval Base San Diego for the last 5 years. Just to follow up with what Felipe had covered. So basically the starting of where you are at is the best point to go from. And so that's just listing out all of the different like payment obligations you may have. And then definitely looking at that debt management plan. To cover a couple of the most common repayment strategies, you have like the debt avalanche and the debt snowball. So the debt avalanche is going to save you the most amount of interest. And so with that, you would line up all of your debts that you may have, where there's a couple cards, auto loan, student loan, whatever it may be. And then obviously you want to make all the minimum payments, and then any kind of additional money you can squeeze out of that budget, you'd want to apply towards the account that has the highest interest rate, no matter what the balance may be. The other option would be that snowball. And so that's doing the same thing, but instead of going by interest rate, you'd be going by the actual dollar amount itself, and then applying those monthly minimum payments. And then for the snowball, you would apply any extra amount towards that smallest debt. And then once that gets knocked out, you take that newfound sum of money and apply it to the next smallest and the next smallest. And the benefit to that one, even though you may pay a little bit more in interest over the life of the loan, is that it kicks in those behavioral and psychological benefits of knocking down those like monthly obligations. And so that can really be a big benefit. You'd cover the debt management plan. So obviously you want to be speaking with the institution that you're working with, or whoever that might be, to see what options they offer. Additionally, you could look at, if it's multiple cards, you could try to move the interest rate. So you could do a balance transfer. So you can, if you have 3 different credit cards and one's at 27, 22, and 15%, or down in like the like 10%, whatever it may be, then you could look at, if you have available balance for it, you can move from the higher interest rate cards down to the lowest interest rate card. And that'd be one way to save money. Additionally, it's not right for everyone, but you could also look at a debt consolidation loan. And that's where you'd be able to include multiple different types of debts that you may have. And then that way you'd be able to get it under one payment, which may reduce your monthly obligations. And then it also just allows it to simplify your life, where you're not having to make 5, 6, 7 different payments. You have just the one payment. So it's a lot easier to stay on schedule and also to plan for.
Awesome. Thank you, Mr. Steve. We're moving on to crisis lessons learned. So moving out of COVID, what are some lessons learned and advice for families to get through crisis? Ms. Rena?
So working with STEP, many families have been reaching out to us because of being negatively impacted by COVID. Before COVID, many of them had what we call an emergency fund, but COVID brought on unexpected loss of jobs, loss of income, increased expenses, childcare was shut down, schools were closed, many instantaneous changes that had financial implications as well. And some families realized that that emergency fund was not large enough to survive the entire pandemic. We're just now starting to come out of it. So definitely a lesson learned. Find out what it is that you want to have in your emergency fund. Do you want to be able to sustain the same quality of life if something happens, or do you have areas that you will pull back on? And taking that into account, how large your emergency fund needs to be. Another lesson learned: when you're facing a crisis, whether financial or personal, I want every family to remember that you are stronger than you realize. You can get through this crisis or any future crises. Reach out for help when you need it. Don't hesitate to reach out to many of the resources that you're seeing here tonight. They're here to help. They're here to get you through it. And they're ready to help you develop a plan to tackle this so you can come out stronger on the other side. And of course, don't wait until you're already overwhelmed, or instead of a month in, it's 3 months in and things are just growing and growing. Whether you're being, preemptive or you are in the middle of a crisis, reach out and seek that help and that assistance from the many resources that are ready to help you.
Awesome. Thanks, Rena. Steve?
Alrighty. I really don't have much to add on that. Rena was able to cover a lot there. Just a couple of specific things. Some institutions offer specific educational guidance. So I know with Navy Fed, we have over 340 branches, and all of the member service reps are able to give some of that education. There's also special programs that different institutions have. For us, it's our personal financial management courses. And so they can help assist with making a budget and assist with looking at debt counseling and looking at restructuring and looking at like all the different options that are available to you. And it gives you that breathing room to then make your next move. So it allows for like a clear thought process going into it. And so you can make the best informed decision going forward.
Thank you. Moving on, the next topic that we're going to be talking about will be the thrift savings plan. Can you explain what TSP is? David?
Hey, sure. So thrift savings plan, TSP, that is your civilian equivalent to my 401k plan. With the TSP, with thrift savings plan, boy, there's so much stuff to cover. In a nutshell, right now, so in this audience, I'm sure there have some people here under the blended retirement system, and there's some people here under the high 3 retirement system. Regardless what flavor, I encourage you to be involved in Thrift Savings Plan, TSP. That's your investment vehicle for retirement. When you get to the retirement age of fill in the blank, we'll just say 67, you can either focus on having your $5 million there, or think about all the different streams of income. TSP is an income stream that will be available for you when you retire. If you're under the blended retirement system, oh my gosh, you got to be in TSP, because if you're not, you're missing out on free money. And if you are, you need to be contributing a minimum of 5%, because when you give 5%, the government will match that 5%. So now you're giving 10%. And the experts, the theys, tell you that you want to save or invest a minimum of 10%. Now that 10% isn't what's left over. When you do your spending plan or your budget or whatever you want to call it, listen, in the military, we always PT first thing in the morning, because if I don't get it done in the morning, life happens and I'm not going to get it done in the afternoon. Well, all too often we build our budgets the same way. Well, I got to go to Starbucks, I need McDonald's, I got to get insurance, I got to do this, that, and the other thing. Hey, I'm left with $150. So I'm going to put $75. No, you got to start right off the top, pull out your 10%, and then start building your plan. So in T, there's other benefits to it as well. I'll let Mark talk about it. I won't steal the thunder. But the bottom line is somebody early on asked a mechanism to save, to invest, investment vehicles, go on your trips and stuff. I don't know about you, my kids in the mid-20s, it's like life is going to end in 2 more years. They're talking about going to Europe and all this kind of stuff. Man, I'm 55 and I haven't been to Europe yet. Okay. But I'm looking at all that money that I'm saving in TSP and 401k that when I retire, then I can enjoy my European trip as I want to. So that's what I look at, not when I'm 22 or 25. But you need to have the money go in there first to enjoy those European vacations. Mark, go ahead and tell them some more about TSP.
I'm going to say this. It's actually Mike Wilbanks. And the reason why I'm leaning towards Mike Wilbanks is he's retired military. And then when we talk about TSP, it's actually a registered representative. So he can go ahead and give you advice. So go ahead, Mike. Can you go ahead and talk to him?
Yeah, absolutely. Thank you, Kyle. My name is Mike Wilbanks, 21 years Navy and some 24 years now with New York Life. I'm a registered rep. I'm not captive to New York Life, but I have a securities license and I help people with all types of retirement planning, whether it's TSP, 401ks, IRAs. The TSP has 2 options actually that David was talking about. It has a Roth version and a traditional version. One is to allow you to put money and lower your taxable income, your adjusted gross income, temporarily until you retire. The other one is after-tax monies. But the nice thing is, especially if you're younger, the Roth version of your TSP will, and it's based on Senator Roth. That's where they got this name, Roth, years and years ago. And so I think the TSP started the Roth version in 2012. So if you've been with TSP longer than that, you have that option currently going forward. With the inevitable monies going to the COVID and I just see right now on the news that President Biden has just finished his 100th day. Well, tomorrow's his 100th day speech. Inevitably, taxes are going to go up. So when you go to retire, it used to be the traditional plan was better because you would be in a lower retirement, a lower tax bracket. Today, we're at the lowest tax brackets that we've been in over 40 years. And so when you think about what's future, there's a lot of the economists are maybe in a higher tax bracket, even if you're retired. With the military people and the federal employees, we do have pensions, which is a leg up on most of America, which is fantastic. So within your TSP, you have different investments. I can help and converse with people about that since I do have a securities license, what's best for them. And if you're young, the theory is be aggressive. If you're older, be more conservative. But there's a lot more to it than that, because just because you're young doesn't mean you should be aggressive, because it may not fit your style. So we help people with their investment style in order to decide what's best. All right, so you get out of the federal government and you can no longer contribute to your TSP. What do? You can leave it there. You can roll it over so you can still contribute. And there are options with that. The TSP is one of the lower cost financial vehicles out there. Every vehicle in the financial world has fees to it, whether you see it or not, whether you pay out of pocket or not, there's fees. They don't build buildings to not have fees, and they don't pay employees not to have fees. So there's fees on everything. It's just how is it set up, and we help people with that, explain whether it's a 12B1 or whether it's a fee. If you go to the tsp.gov or .com, it tells you about the fees of each fund. They're the 20-something fees funds, which means like if you're going to retire in 2050, there's a 2050 fund. So it's kind of a park it and lock it. As you get closer to 2050, it becomes more conservative, but right now it'd be very aggressive. And then there's the 2025 fund, which is very conservative because we're really close to 2025. But then there's the 5 other funds that the TSP originally started out with, from the government fund, the G fund, all the way to stocks. And stocks are equities, and the Dow Jones or the S&P 500. And then there's the bond fund. So bonds are low right now. As interest rates go up, the bonds will be high, will produce less. And if the market crashes, everybody looks at the Dow Jones, then the value of your fund goes down. But your shares, you still own your shares. You never lose your shares. the value of the shares, like housing or a car, can go up or down. So we help people. What's the right amount to have in your TSP? How much do you need to retire? We look at the Social Security. We look at your pensions. We look at what you're trying to do, how to pass it on to the biggest thing at the Secured Act in 2020. I don't know if anybody really realizes what a Secured Act is, but the government passed it as part of this whole COVID thing. Now, if you pass your retirement plan, I don't care if it's an IRA, TSP, 401k, all the above, a spouse can continue it. But anyone other than a spouse, they have to liquidate that taxable account within 10 years. So that's a new government rule. And it's important to make sure when you're planning to who is your beneficiary, who is going to take over these plans in the future if something happens to you prematurely, or you don't spend it all. You have to start taking money out of all these qualified plans other than the Roth. The Roth is different. You have to start taking those monies out by age 72. The earliest, there's rules that the earliest, most people wait till 60. You can take it out. There's rules where you can take it out before and minimize the taxes. But if you take it out, if you're 40, you're going to get a 10% penalty on top of being taxed. So it's not a savings plan for temporary. That's what the Navy Federal can do. That's what USAA can do. They can do the short-term holding money to save up for a car or down payment on a house. This is for retirement planning specifically. So we help people and explain that to them to help them for when they do retire. If you think about your parents or your grandparents, maybe they just had Social Security, but maybe they paid off their house. Maybe they had a pension. Most companies don't have pensions nowadays. What is enough money for you to survive on with inflation factors going into it and the fact that we're living longer? So we know that the Navy retirement for me for the newer people has changed and it's possibly going to change in the future. So it's important to put money away. No one ever has said, I have too much money in retirement. Well, maybe Bill Gates, but no one's ever said that. It's usually a little bit the other way around. Kyle, do you have anything?
We'll talk about the retirement on the other side too, so I don't have anything to say.
Awesome. Thank you, Mr. Mike. Actually, he kind of segued us right on into our next question about retirement. So we have a wide range of military families on here, from just starting out to getting ready to retire. What are some things that the family should start thinking about?
So first, get excited for a new chapter of your life. New chapters are always exciting, but also recognize that it's going to take a minute to adjust psychologically, right, to the change. And because of that, we really recommend that you plan financially as far in advance as you can, so that you don't have that extra stress and that extra burden once you retire. How do you plan in advance? One, take advantage of whatever you can get for free, okay? The will. You can go to Base Legal and get a will for free. So go get it before you retire and you have to pay somebody like me $1,500 an hour to prepare something that, again, you can get for free. Number two, save as much up as you can in advance, really, because when we don't have savings, we don't have choices. You don't want to be stuck in a job that you don't want, or that isn't good for you, or that isn't taking the best advantage of your talents because you can't afford it. You want to save up whatever you can, as much as you can in advance to be prepared. And I would also like to suggest doing a practice budget. A budget, what is it in 10 seconds? You make a note of what's coming in and you make a note of what's going to go out. How do you make a note of? You give every dollar coming in a job. No dollars float around without a purpose in life. Every dollar that comes in is going to your monthly expenses, to your savings, or to pay down debt. So try to think what your budget is going to be upon retirement and live that budget. See if it works, give it a try. Because if it doesn't work, you got to do some tinkering. And the time to find out that it doesn't work is after you've already retired, right? Try to pay off as much debt as you can before you leave. You want to have a nice, fresh, clean slate when you leave. So I really encourage people to try to get rid of all that bad stuff. Last but not least, I encourage people not to make any major decisions immediately after leaving. You got enough stress in your life as it is at that point. Okay, that is not the time, in my opinion, to buy a huge house. Okay, give it a couple months. It doesn't hurt to wait a little bit. Make sure you're in a good, stable financial position. I'm going to put a footnote with that. VA loans, everybody talks about them like they're the best thing since sliced bread. They are awesome. They are definitely awesome. But don't use it as an excuse to get a house. In other words, if you couldn't afford to buy property without it, maybe you can't afford to buy it with it. And the only reason I know this is, having owned various properties over time, it is always more expensive than you think it is. Always. You're going to have a leak that you find out insurance doesn't cover. Your washing machine is going to break down for absolutely no reason, even though you just bought it. Okay. So if you're tight on money and the only way you could make it work is with the VA loan, and even then you're going to be tight, it's not the right time. Give it a minute. Wait a little bit. Get yourself settled. So that's just an example, but try not to make any major decisions before you're settled. And that's it, really. If you're having trouble, coming up with a predicting budget, you can always come to NMCRS. You can make an appointment with us, and we'll sit down with you and help you kind of sketch it out.
Awesome. Thank you, Gretchen. Kyle?
All right, go ahead, Mark. And then after Mark, Mike, you can go ahead and talk after Mark.
Hey, thanks again, Kyle. One of the things is that with the retirement, it's something that you worked for. As you learn, the survivor benefit plan is something that you need to consider. And speakers that you'll hear will often use this scenario to you, is that after you retire, month after month, you're going to receive your pension. And either back in the day, they used to use a mailbox, but now they say it's direct deposit. If the service member passes away, then the next month the spouse goes to collect that pension, and it's not there because it doesn't transfer. So there's this option called the survivor benefit plan, and it allows you to leave a portion of your retirement to take a reduced pension during your life. And so the question that I often ask when I'm sitting down with my clients are, what happens if your spouse passes away before you? What if you both pass away at the same time? And then the third scenario is that what if you pay in the list for a number of years, and then your spouse, there's not a guaranteed sum of money that's going to be passed on. It's only while that person is still alive. So there's some other options in there for you to consider, and those are some of the things that Mike and Kyle and myself, we all work with to make sure that you can go over some of those options. But there really isn't, there's never a one size fits all. That was one of the biggest shifts in the mindset that I had to change, was that, we always got those three questions. Did you update your page 2? Did you update your SGLI? And are you invested in TSP? Check, check, check. The visitor in the spotlight. We're all good, right? But now it's more customized, and that's the most important thing, is with all of these advisors here, you have the resources to go in and ask the right questions, so that you don't have to go one side or the other. You can actually do kind of a blend between the two. So I really truly recommend that you sit down with someone before that, and the spouses that have gone through all of the deployments. They've gone through, having you go to all of these schools and in and out, especially when we were in the Marines or the Navy, we're always gone. And it's always something that they feel like it is their benefit. And if you waive the survivor benefit, they have to sign off on that. So there's always that conversation. And I always suggest that all of us sit down together and go over all of the options. Mike?
Thanks, Mark. So yeah, the survivor benefit, what is the cost to it? It's 6.5% of whatever you're doing it, up to 50% of your benefit. So if your benefit is $1,000 a month, then 6.5% of 1,000 would equal what the monthly payments are, and you pay that forever until, of course, you pass. So that's just one part of your overall retirement planning. And the other part is a TSP. And a lot of people, when they retire from the military, they're going to get another job, whether it's with the DOD, the federal government. A lot of times they just transition. Then you can continue your TSP if it's a federal office. So you can just continue to contribute within that. I saw someone put in something about asking if they were a federal employee and they go to retire, can they keep their insurance like the military can? The military can keep the SGLI to the VGLI. It's a 5-year term, increasing every 5 years. It works great during the early years, but it works like Mark was saying. It gets so expensive and when you hit your 70s and beyond. But you can lower the death benefit too as time goes on. So these are all things. Remember, life insurance bypasses probate, which Gretchen was talking about, and goes straight to the beneficiary tax-free. So that's part of a plan, right? It doesn't mean you plan on dying. Some people know they're going to die. Most people don't know when they're going to die. If we knew when they were all going to die, we could plan a lot easier and we wouldn't maybe need insurance, or we would need more insurance. But what happens is the money is important too. So we know we're going to have a cost of living. Gretchen and some other people were talking about having a plan, having a budget, having as low a debt as possible. Dave Ramsey, Susie Orman, these people talk always about debt management. They're not necessarily great on a lot of things, but I have to agree, most people can agree, debt will ruin a lot of retirement planning if you carry too much debt. Stay within a budget, stay within a plan. And your TSP, I mean, if anybody's matching, come on. If you went for a company, one of the biggest things companies can say if they have 401k, hey, we match 3% is kind of the norm. And, you know, your TSP is doing better than that. Most people are under, most people don't have enough money to retire on. Let's say you had $1 million in your TSP and it was getting, because now you're retired, it was getting a 5% return. What is that equal to an income without touching the principal? That's only $50,000 a year, okay, without touching the principal. And then if you died, then if your spouse can continue it in the same way, but if it's your children or any other institution or person, that money has to be liquidated within 10 years. That's a big tax ramification for people. So if it's a Roth, not a problem. The Roth can continue forever with any beneficiary. So you have to talk to a professional. You can Google all of this stuff, but you can get mixed conversations and mixed emotions, mixed what to do next. There's a lot of good information here from a lot of good people that are here to help the military people. And most of us, or a lot of us, have been our prior service. And 21 years, somehow I got an honorable discharge. I don't know how, but it was in the works. And I'm very grateful for it. I didn't mean to make it a career. It ended up being a career, and I'm glad now, 24 years later, I'm glad that I did it. Your health benefits, although they keep diminished, are fantastic, because if you were paying for your health benefits, family of 4 in their mid 30s, early 40s, you could be spending close to $2,000 a month for your health insurance. So that's a big deal. That's a fantastic deal. So thank you for your service. Thank you for your dedication. You have a lot of great benefits. I know you don't have a lot of great pay in most cases, unless you're a senior officer. But it's a living, and it has the benefits are greater than most companies out there.
Thank you very much, Mike. And I'd just like to thank all of our panelists again. If you guys could just join me in a good round of applause to thank all of these wonderful panelists for this evening. Other than that, we wish you all a very, very good night, and thank you all.